All of the investments that we're going to talk about, you have your choice of cash, bonds, gold, commodities, real estate, private assets, and common stocks. So you have many different choices. Some of these assets do better in certain times and others do better in other times. For example, cash is the ultimate investment in deflation. What most people don't realize is you don't need to have a lot of cash to protect yourself from deflation, because if we were ever to go to a depression, your cash would increase 6 to 1. In other words, if you had $100,000 today, it would be worth $600,000 if we were at the bottom of a depression. So you don't have to have all your assets facing one way, even if you believe there's going to be a depression. So cash is obviously a great asset for something of that nature. Bonds would be the same category. They give you a yield in addition to the cash. Gold and other commodities would not do as well in a deflationary environment. In a light deflation, gold will do fairly well. Gold will not do well in a depression. Neither would any other commodity. And when it comes to inflation, gold and commodities would do very well. Cash and bonds wouldn't do very well. Real estate would do very well. Private assets and common stocks. So if you look at the ranges that you have and the possibility, you can design a portfolio to cover yourself in all of these areas and still have enough assets working for you in case it goes the other way. Then as it moves one way or the other, you just move your assets around. Now I'm showing you a chart that most of you have probably seen. Basically, it's a chart of all the assets over a period of 35 years. I can show you a chart 50 to 60 years and it would pretty much look the same way. So what you have is you have stocks averaging 12% over that period, business, real estate 9%, international stocks 7%, gold 7%, crude oil 5.9%, and inflation at 3.88. So you can see that common stocks in an area of 35 years have done pretty well, even though we've had 5 serious recessions during that period. We've had serious inflation. And over the long run, I believe that common stocks are the way to hedge yourself over the long term. But here is why common stocks are so unique. And this is the main point I want to make in this seminar today, is that when you have a common stock, you have cash, which obviously is a good thing to have. You have inventory. You have real estate, buildings, manufacturing facilities, etc., do well during inflation. But most important of all, you have human ingenuity. And I can't express the importance of understanding that principle in common stocks, that irrespective of what managers are faced with, they have the ability to navigate these environments, make their adjustments, and that's why you have such extraordinary outperformance in common stocks over the long run, provided that they are bought right. And that's a key point. And let me give you an example. Apple Computer was started in a garage 35 years ago. It's worth $600 billion. Microsoft was started a year earlier. It's worth $250 billion. And Nike, which is a non-technology stock, just a tennis shoe company, was started 10 years before that. It's worth about $50 billion. If you combine those companies, you almost have $1 trillion worth of market cap, almost 10% of all the value in common stocks is just by a handful of entrepreneurs who believed they had an idea, followed it through, and basically started it out of nothing. 2 of these companies were basically started in the garage. So this is what makes common stocks such a unique investment if you understand that human ingenuity can navigate all of the kind of things we're faced with.